head now to Chicago and to Bloomberg's Deirdre Bolton, who is at the University of Chicago's Booth School of Business, which was just ranked first in the Bloomberg Businessweek roster of best business schools in the United States. Deirdre.
Betty, thank you very much. I'm here today in the Student Center with someone known as the father of modern finance. Professor Eugene Fama is sitting right beside me. And Professor, it's so glad to speak with you. You're the originator of market hypothesis, efficient market hypothesis, which essentially implies that all known information is already in the market. The market is right, people aren't. Some people have been discussing this hypothesis post-credit crisis. How does it affect the way investors look at the markets now?
Most investors don't believe that markets are efficient, so I don't think that this episode will change their views in that respect. But the efficient markets hypothesis and all the research that's been done on it says a lot to investors. Basically, it says that it's impossible to pick people who can beat the market, and you're better off just investing in low-cost, low-fee vehicles, mutual funds, whatever.
So, as far as stock picking, you throw that out the window,
right.
And no money in bonds, for example.
No, bonds are fine, but, well, the bond market's efficient as well, so picking bonds is probably as difficult as picking stocks. But the evidence is pretty strong that active mutual funds don't perform passive mutual funds. Active mutual funds mean those that try to beat the market. That's a series of research papers that goes back to the early 60s. It's never been any different. So,
what does it mean, though, as far as what should be done now post-credit crisis, let's say, for example, with regulation?
Oh, regulation is something different. So regulation is about the companies in finance, not about markets. I think markets worked rather well during the crisis. Whether financial firms have to be regulated, I have opinions on that. I think they need lots more equity capital, much more than anybody's talked about. The big distortion in the system at this point is too big to fail. The whole concept of too big to fail. That's distorting markets all over the place and behavior all over the place.
To pick, for example, Basel III, are the requirements there for capital simply not high enough?
Not high enough.
What would you like to see?
Where you want the capital requirement is the level that would have caused financial firms that are so-called too big to fail not to have failed in the recent crisis. You need enough equity to make that work.
What is the right percentage?
I don't know, but it's much higher than 5%, 10%, maybe it's 25%.
Were you frustrated at all by the fact that it's going to take so long, even by Basel III regulations, for companies to adhere to those suggestions?
It shouldn't take a long time, really, but they'll rebel against doing it because they have some misguided ideas about how that affects their return. Basically, they're confused about the fact that your returns come from your assets, not the way those assets are financed. So if you have the same set of assets, the overall return of the company will be the same, right, regardless of how much equity you have on the other side. So I don't know whether they consciously try to mislead people on that score, or they just don't understand it.
We'll hope not. But in the meantime, Professor, thank you very much. Professor Fama joining us there, known as the father of modern finance. And Betty, just part of the brain power that is here at the Booth School of Business, University of Chicago. Back to you in New York.